Hello everyone. I am very happy to welcome you all to Dr. JJ's Virtual Academy of Commerce. In this video, I am going to detail the calculation of short-term solvency, long-term solvency, profitability and turnover ratios using a practical problem. These are all a few details related to me. Let us get into the problem. Given below is a summarized balance sheet and profit and loss account of Rajalakshmi Sugar Mills as on 31/12/2017. You are required to calculate the following ratios: current ratio, quick ratio, fixed assets ratio, debt equity ratio, proprietary ratio, stock turnover ratio, fixed assets turnover ratio, return on capital employed, debtors turnover ratio, creditors turnover ratio, net profit ratio and operating ratio. Look at the balance sheet of the company. Issued capital 40,000 shares of 100 rupees each amounted 40 lakhs. Reserves, creditors, creditor is a current liability. Profit and loss account, 6% debentures is the only long-term liability given in the problem. Now look at the assets. Land and building is a fixed asset or non-current asset. Plant and machinery is also falling in the same category of fixed asset. Stock, debtor and cash at bank are current assets. Then regarding profit and loss account, we are given with the details. There is a gross profit of 68 lakh rupees. Then look at the items that are debited in the P&L account. Administration expenses and selling and distribution expenses are operating expenses, whereas the financial expenses and other non-operating expenses are non-operating items that are debited in the P&L account. Then regarding the credit side, you find non-operating income amounted 1,80,000 rupees. These are all the important points you can make a note from the balance sheet and the profit and loss account. Now let us look at the calculations of the ratios. Current ratio, the formula, current assets divided by current liability. Current assets, as I said, stock, debtor, cash at bank, put together it comes to 50 lakh rupees. Fine. Regarding current liabilities, as I said, there is only one item which is nothing but creditors amounted 26 lakhs. So the answer of current ratio is 1.92 times, which is a bit lesser than the ideal current ratio of 2. Then regarding quick ratio, the formula quick assets divided by quick liabilities. Since there is no bank overdraft in the problem, you can say current liabilities are equal to quick liabilities. Quick assets, how to calculate quick assets? Current assets minus stock and prepaid expenses will give you the quick assets. 50 lakh rupees is the value of current assets. If you subtract the value of stock 29 lakh 60,000 from that, you get the balance of current assets amounted 20 lakh 40,000. That is the value of quick assets. Or you can directly calculate by adding debtor and cash at bank, you get the total of 20 lakh 40,000. That's the value of quick assets. So 20 lakh 40,000 divided by 26 lakhs quick liability is equal to 0.78 times. This is also a bit lesser than the ideal quick ratio of 1. The next ratio calculated here is fixed assets ratio. Fixed assets divided by long-term funds. Regarding fixed assets, we found two items in the balance sheet. One is land and building, the other one is plant and machinery. The total of them comes to 46 lakhs. Regarding long-term funds, we need to add the shareholders funds and long-term liability to get the long-term funds, which could be otherwise called as capital employed. Share capital 40 lakhs, reserves 18 lakhs, profit and loss account which could be known as surplus 6 lakhs, debentures 6 lakhs, put together 70 lakhs is the value of long-term funds. So 46 lakhs fixed assets divided by 70 lakhs long-term funds, it gives the answer of 0.66 times. That means 66% of long-term funds is invested on the fixed assets of the company. The remaining 34% of the long-term funds is used for the fixed portion of its working capital. The next ratio calculated here is debt equity ratio. What is the formula? Long-term debt divided by shareholders funds. There is only one long-term debt which is nothing but debentures 6 lakh rupees. Regarding shareholders funds, share capital plus reserves plus P&L account will give you the shareholders funds. So it will come to 64 lakhs in total. So 6 lakhs divided by 64 lakhs is equal to 0.094 times is to 1. So you find this concern greatly depends upon shareholders net worth. Fine. The next one, proprietary ratio. Shareholders funds divided by total tangible assets. In this concern, there is no intangible or fictitious assets like goodwill. Therefore, the total assets is nothing but the total of tangible assets, 96 lakhs. Regarding shareholders funds, that we already calculated, 64 lakhs divided by 96 lakhs is equal to 0.67 times. That's what proprietary ratio. What is the meaning of this? 67% of total tangible assets is funded by shareholders fund. And the next one is about stock turnover ratio. Cost of goods sold or cost of sales divided by average stock. What is the formula for calculating cost of sales? Sales minus gross profit will give you cost of sales. Here it is amounted 1 crore 70 lakhs, that's the value of sales, minus gross profit 68 lakhs. So cost of sales is valued 1 crore and 2 lakhs. What about the formula for calculating average stock? Opening stock plus closing stock divided by 2. 19 lakh 90,000 plus 29 lakh 80,000 divided by 2, it gives us 24 lakh 85,000. That's the value of average stock. Now let us calculate stock turnover ratio. 1 crore and 2 lakhs divided by 24 lakhs 85,000 rupees is equal to 4.10 times. The concern has to really improve its utilization of stock. The next one, fixed assets turnover ratio. Cost of sales divided by fixed assets. Cost of sales, we calculated it as 1 crore 2 lakh rupees. What about fixed assets? We found two items given in the balance sheet. They are nothing but land and building valued 30 lakhs, plant and machinery valued 16 lakhs. The total comes to 46 lakhs. Now fixed assets turnover ratio. 1 crore 2 lakhs of cost of sales divided by 46 lakhs, a value of fixed assets. The answer is 2.22 times. You can make use of this formula for calculating fixed assets turnover ratio. This is really not required. Return on capital employed. The formula profit before interest and tax divided by capital employed into 100. Or you can make use of operating profit divided by capital employed in the business into 100. Operating profit over here could be calculated as what? From gross profit, if you subtract the other operating expenses debited in the P&L account, we will come to know operating profit. It will give you the answer of 32 lakhs as a balance, which is nothing but operating profit. Or else what you can do, take net profit 30 lakhs. You add this non-operating expenditure 80 lakhs. You also add the 3 lakh rupees of financial expenditure, which is nothing but a non-operating expenditure. Now you deduct the non-operating income 1,80,000, you will get the balance as 32 lakhs, which is nothing but operating profit. I think they have followed the second method which I explained. Net profit plus non-operating expenses already deducted plus interest minus non-operating income. It will give you the answer of 32 lakh rupees. Or else, as I said, from GP you subtract the other operating expenses debited in the P&L account, you can come to know operating profit. So instead of this numerator, we can very well write operating profit divided by capital employed. It would be more appropriate. What about capital employed? Shareholders funds plus long-term liability. It comes to the total of 70 lakh rupees. Share capital 40 lakhs, profit 6 lakhs, reserves 18 lakhs, put together gives you shareholders funds. You add 6 lakh rupees of long-term funds, with that you get the total of 70 lakhs as the capital employed. So 32 lakhs divided by 70 lakhs into 100, it gives you the answer of 45.71% as a return on capital employed. Then regarding debtors turnover ratio, credit sales divided by average debtors. In the absence of information related to credit sales and cash sales, you assume the total sales as credit sales. That is what done here. 1 crore 70 lakhs in total is treated as credit sales. Divided by average receivable, that's nothing but debtors plus bills receivable. If you don't find opening debtor and opening bills receivable, you can take the total of closing debtor and closing bills receivable. That is what done here. You get the total of the closing debtor and closing bills receivable amounted 14,20,000. So the answer is what? 11.97 times. That's what debtors turnover ratio. How to calculate debtors collection period? Average receivable or closing receivable. In the absence of opening receivable, you can take only closing receivable. As I said, closing receivables is nothing but closing debtor plus closing bills receivable. Divided by credit sales into 12, you can directly calculate 1 month as the answer of debtors collection period. The same could be computed using days also. Closing debtor plus closing bills receivable, which is nothing but the total of closing accounts receivable divided by credit sales into 365, it gives us 30 days as what? The debtors collection period in terms of days. What about the next one? Creditors turnover ratio, credit purchases divided by accounts payable. This is supposed to be average accounts payable. In the absence of opening accounts payable like opening creditor and opening bills payable, you can take closing creditors and closing bills payable. That is what collectively named as closing accounts payable. In the absence of information about cash purchase and credit purchases separately, you can assume the total purchase as what? Credit purchase. That is what done here also. So 1 crore 9 lakh and 5,000 rupees divided by the closing accounts payable 26 lakhs is equal to 4.19 times. What about the creditors payment periods in terms of days and months? The closing accounts payable divided by credit purchases into 12, it gives us the answer of 2.86 months. Then the next one in terms of days, the closing accounts payable divided by credit purchases into 365 days, it gives us the answer of 87 days as a creditor payment period in terms of days. The next one is about net profit ratio. Net profit divided by net sales into 100. Net profit 30 lakh rupees, that is directly given in the problem. Then net sales is amounted 1 crore 70 lakhs. This is also given in the problem into 100. The answer is 17.64. Then regarding operating ratio, cost of goods sold plus other operating expenses debited in the P&L account. Cost of goods sold, yes, that's nothing but sales minus GP. Sales is 1 crore 70 lakhs minus gross profit 68 lakhs. Therefore, the cost of goods sold is amounted 1 crore and 2 lakh rupees. What about the other operating expenses like administration expenses 30 lakh rupees, selling expenses 6 lakh rupees. What about the denominator? It is net sales. That's nothing but 1 crore and 70 lakhs into 100. It gives you the answer of 81.17%. This is what operating ratio. Therefore, the operating profit ratio is nothing but 100 minus 81.17%. If it is asked to be calculated, you can answer it this way. I hope you have understood my explanation over the calculation of all these ratios asked in the problem. I suggest you to watch this video for more than 2 times to gain a clear understanding over the calculation of all these important ratios of the chapter ratio analysis. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.